Welcome to the Dealmakers Coffee Break. I'm Asaf Raz. Let's go. So welcome to another episode of the Dealmakers Coffee Break edition. And today I have the partner and chief investment officer of Railfield, Jon Siegel. Jon Siegel has vast history in real estate. It's been since 1992, which is literally when I was born. So a lot of respect for that. But yeah, without further ado, please take it away, Jon. Tell us about yourself, what you're doing today, what you're focused on, and we'll take it from there.
Great. Yeah. No, you make me feel old now. I always say I've been in real estate longer than I care to admit, but you just spoiled my secret. So I guess I'm literally old to your father, maybe. So I've been in real estate, primarily multifamily, for a long time now, over 30 years. And I've been on both sides of the table. I actually originally worked for a company that was the largest owner of apartments and largest manager of apartments in the country back in the 90s, called NHB. And there I did acquisitions. And I would say they were sort of, I don't know if they were dumb enough or not well run enough to give a guy that was in his 20s a lot of latitude to do a lot of deals. So they sort of, I was supposed to be sort of an analyst when I started, and I was willing to stay up all night and travel all the time and everything. And it ended up I was doing multiple thousands of units deals as the business guy pretty quickly. And so it was a great experience. I guess I can say I made some mistakes with other people's money, as they tell you to do. And that company, though, actually, interestingly, was a public company. It was actually owned by the endowment of Harvard University. And then they wanted to monetize their investment. So they took the company public, and then they said they wanted to buy a REIT to merge into it. And so that was one of my assignments. We were working on buying a REIT. And we had some investment bankers, and there was going to be a meeting between the head of our company and the head of the REIT and the guys from Harvard. And so it was above my pay grade. So the next morning, they had the meeting. The next morning, I go in to the CEO. I say, "How was the meeting?" He says, "Slight change of plans. They're buying us. We're not buying them." So that was the end of my time there. Usually the acquisitions guy is the first to go. And wow. So I transitioned pretty seamlessly, though, to becoming a lender. And so I started working at Fannie Mae. And so Fannie, obviously, and back then was by far the largest. Now Freddie and Fannie are, I guess, around the same size, but was the largest, lender in the multifamily space. And at Fannie, I did two things, which is I did what they call the structured transactions. So when a REIT or a big organization does a deal with Fannie, if you do a one-off loan with Fannie Mae, you do it through your lender, and nobody ever talks to Fannie Mae or knows who anybody is. But when you borrow, a couple $100 million or more, Fannie gets involved, and somebody at Fannie has to do the deal. And then that was my job. And so we did everything from, $100 million credit facility for somebody to the biggest deal we did was the privatization of the Archstone REIT, which was an $8 billion deal. And so large deals. And I also started and ran Fannie Mae student housing. So when I got there, Fannie did not lend. They would not. It was like a bright line, would not lend on student housing. And I was dumb enough to ask the question, why wouldn't we invest? Why wouldn't we lend on student housing? And they were like, "Oh, it's too risky." I was like, "Really? I don't think it's that risky." So they were like, "Well, tell us why it's not, make a proposal." So wrote up a memo, and lo and behold, they were like, "Okay, we'll start lending on student housing and you can be in charge of it." And I was like, "But I already have a full-time job." So I was there at the beginning of that. But I worked for two big companies and always had the entrepreneurial itch, and I had done some deals on the side, buying smaller multifamily. And I think it was the worst kept secret of Fannie Mae. Everybody knew I was doing it. And so one day, one of the guys who's one of my partners now came to me and said, "What you're doing, I'd like to do. Maybe we could do it together." And that became the genesis of us leaving Fannie Mae and trying to start doing this on our own, which we did during the great financial crisis, which was probably not the best timing. But we kept ourselves going.
It depends on who you're asking. It depends on who you're asking, right?
Yeah, exactly. Yeah. I guess in retrospect, it probably was a good time. But we sort of kept the lights on by doing a ton of advisory work. People came back and hired us to do all kinds of deals for them as we were trying to raise money and figure things out. And the guy that ran multifamily at Fannie Mae when I worked there is a guy by the name of Ken Bacon. And Ken left Fannie a couple of years after we did. And he was trying to figure out what to do next. And he was on the board of a company called Artemis Real Estate Partners, which is a big investor. And his pay for being on the board, Artemis, I think had started recently. They gave him an office. So he was sitting there, and Artemis had gotten the assignment to run what they call the emerging manager program for New York Common, so the big pension fund from New York. And they have, I would say New York Common has like, $1 trillion, and there's like 8 people work there. And so they, they want to put out money in smaller chunks and with smaller companies. And so they hired Artemis to run this program. And so they were trying to put the money on. I think they were getting pressure from New York Common to actually do something with a small company or a startup. They said, maybe do a startup. So one day they called across the hall to Ken and said, hey, you ever think of starting a multifamily company? He's like, I don't know. I don't really want to raise money. That's kind of a pain. And they're like, we don't have to raise money because we have money. And so Ken, who is, as we call our designated big shot, he's not going to do a model or write a memo or something like that. So he called Todd and I and said, hey, you guys want to start a multifamily company? We're like, that's what we're trying to do. And so that was the beginning of Railfield, which is my company now. And so we had 3 partners. And as I say, we started on third base with money from a pension fund. And we kind of naively thought that this pension fund, we'd spend the money from this JV, and then we'd just get more pension fund money, and that would be it. And we'd grow, and it would be, enormous. And so we bought our first couple of properties. They told us they wanted us to focus on Texas. And so we bought our first couple of properties in San Antonio. And we spent the money they gave us, really. And then it turned out that other pension funds weren't really that interested in investing with 3 guys sitting in a room to have a couple of deals in San Antonio. Pension funds are looking for people that are well established with a track record. So we had to pivot, and we ended up forming some other capital relationships. And, long story short, and I can give you a lot of detail about what Railfield does, but long story short, fast forward 9 years later, we were in 9 markets, the major markets of Texas, along with the Mid-Atlantic and the Southeast. And we focus on value add, and core plus and affordable. So the full spectrum of multifamily. And we have a number of institutional and family office capital relationships. So that's kind of who I am, and that's where I am today.
That's a big history story.
Yeah.
And
a long time to go through.
I feel like you've gone through so much in what you've done, and yet there's something that popped to my mind while you were speaking about multifamily. So if we look at when you started doing what we call multifamily, right? It was 1992, 1993 was the first time that you've started working on multifamily. And I feel like the past maybe couple of years, maybe 3 to 4 years, has been a real there's been a real change in multifamily. It became what I love calling a real estate trend, right? Where people say multifamily, just raise capital and then you can buy a property. What changed? What made multifamily such a spoken of asset type or asset class when compared to historically what it was?
No, that's a good question, because when I started in this business, right, a lot of people didn't want to do multifamily. It was sort of a second tier asset class, and a lot of big institutional investors, they had like no beds. That was their theory. They wanted to do office, and so over the years it has become much more institutionalized, both in terms of companies that are involved in it, but also the access to capital. And so what changed originally was what I guess we call the securitization of multifamily, which is REITs first started putting a lot more institutional capital into the market. And then the access to debt changed a lot, with Freddie and Fannie really becoming bigger players, which happened, around the year 2000 or so, where there became such an access to capital that it became, easier to do multifamily, and the cost of capital is lower. And then, I think then you fast forward along to what happened was demographics changed, right? And so, I'm old now. I'm part of Generation X, which was like the baby bust. And then all of a sudden now millennials and Gen Z, which are a ton of people, and people tend to rent apartments when they're in their 20s, and so the demographics caught up to the institutionalized nature of the business. And then you fast forward then to, the 2010s, as we move towards 2020. And what happened was, the market grew, and then the money got really cheap, right? And so money is cheap. It's easier to make deals work. And then the values went up. And so, people who had invested back in 2013, 2014, or before that, they made a ton of cash because all of the values went up. And there became so much liquidity in the market. And, money follows money. And so as there's so much liquidity, everybody sees it, wants to get into it. And we had this big run up, which, coincided with, the end of cheap money, maybe, and I don't know, maybe it's historically really not that expensive, but comparatively cheap money. And brings us to this inflection point now. So
I've been to, I don't know, have you ever been to IMN?
Yes.
An IMN event?
Yeah.
I was there back in at IMN Dallas last year. And I feel like I've talked about this in a few episodes because I have a few people from Texas, but what I saw was I was sleeping maybe 15 minutes walk, 15 minute walk from the venue. And I said, I'm going to walk. And I started walking, and it was a bunch of scattered buildings, 6-7 stories buildings. And as I walked to the venue, the landscape changed on me. So you'd see a bunch of multifamilies, you'd see a bunch of residential areas all of a sudden with gardens, and they look much better, and they look much more renovated. I feel like it's not only, like you said, not only a trend, it's population change, and people are expecting to live in better locations.
Yeah, sure. Yeah, I mean that's double in Dallas between the general trends in the world of people, maybe pre-COVID, people wanted to live more, and there's a big move into cities or sort of city-like locations, suburbs making all the town centers and all that. And then you have the explosive growth in the Sun Belt, places like Dallas and Austin and Raleigh, Durham and Nashville, all these markets. So many people move there, and there's so much business created there. It all just blew up. But now we're all standing here, in the end of June of 2023, wondering, okay, what happens next?
What happens next? And let's talk about that for a bit. What do you mean? What are you doing currently? Some people are treating the current situation, they call it the downturn. Some people call it a crisis. Others say it's a natural progression of our real estate work. You've been here. You've done that before. You've seen 08. You've seen the bubble burst, right? How are you treating the situation when it comes to your strategy with Railfield today? How does that change what you've done before, or what are you going to do in the future?
Yeah, I guess that's one of the benefits of gray hairs. I guess you've seen, although it's different every time, but yeah, you've seen this movie a little bit before. I don't view this as like a crisis or the end of the world. I mean, I think interest rates went up. Look, interest rates were really low, and now they're probably back to historical levels. And I know that makes it difficult, for everybody, for us included. We tend to be pretty conservative. We have lending backgrounds. And so we tend to always have focused on, cash flow and being relatively conservative in the way we approached acquisitions, which, got a little frustrating, to be honest with you, during, 2021, say, when everybody's buying everything and, we're getting outbid on everything. But we sort of maintain our discipline. And so we have only fixed rate debt. We never did a debt fund loan. We just keep doing what we're doing, which I equate right now to sort of banging your head against the wall, because the pricing is tough to make it work. But I think people, I think what we're going to see here over the next year or so, again, this will sound like this is an old guy saying this now, is that when I talk to everybody in the market, yourself included, which is most people got into this, during this last, I don't even know if the cycle's over, but during this cycle, let's say during the cycle, most everybody who's in this business who I talk to, even if you got into it, you've been doing this for 10 years, which is a pretty long time. You got into it during this cycle. So you haven't seen this before. And then, most people figure it out. And I think the people that can figure it out and have staying power and make it to the next cycle, those are the people that are going to be successful, right? There are going to be some people that are going to have some problems. But I think most people will make it through. And I think a lot of the dire predictions are sometimes overblown. Same thing like with the office market, where like, nobody will ever go to an office again. Like, that's not going to happen. I mean, things have changed, but the office market isn't moving forever. Yeah, it's just different. And so this is different, and we just got to figure out how to navigate this different world. And the way we navigated, which is a long way to wind up to answer your question, is we just keep doing what we do, which is we just we underwrite relatively conservatively. We stick to our pricing, we stick to our discipline, and we don't win as many deals, but we just closed the deal last week. We're still part of the deal.
Really?
Thanks. Yeah, we're still buying stuff. We're still out there looking. And maybe it'll be a little slower for a little bit of time, but you'll probably be rewarded. Especially the one thing I would also say is you will never know when it changes if you're not in the market. So you guys think.
So yesterday I had a call with Rich Bachner. He's from Alpha Investments. I don't know if you know him. And Rich told me a sentence. He said that the only problem with investing in, it doesn't matter what the asset class is to say now the time is different, right? Yeah. The time is never really different. It's like he said, like if you invested in an Apple stock and it went down, what would you do if you believe in Apple? You need to double your investment. So what would you do if you believe in an asset, right? Yeah. So you would double down on the asset. So it does make a lot of sense in terms of how the market is looking right now.
Yeah. I mean, the long-term view, I think, of multifamily is very positive. There's still, the demographics are still good. There's still a lot of demand. There's a shortage of housing in the United States. So people need housing. Maybe everybody doesn't need a brand new apartment right now. But there's still a huge demand. And there's a lot of new construction now, but it'll be gone soon because nobody can get money to do a construction loan now. So, that's a short-term situation. So long-term, I think I'm super bullish on it. We have a property that we bought that is doing well, but it's sort of bouncing along a little bit. And I'm like, look, we bought the deal with a 10-year time horizon. In 10 years, it'll be a great deal.
Everything will be great.
Yeah, exactly. It's true. The benefit of time heals many wounds in this business.
I love that. So as we talked about this in the beginning about multifamily and how it became some sort of also a trend to people that really didn't know. And they, as you said, they came into the market in the last 10 to 14 years. They had this bull run and, interest rates were practically zero, right?
Yep.
So many players went to the space. How did that, or does that influence today what you're doing with Railfield and how you either choose or find new assets, how you raise capital? Has that changed anything in what you do?
Yeah, I mean, I guess it's sort of. I guess the answer is yeah, sure. Like, so when we raise money, we play up how experienced we are. We've seen multiple cycles, so that's marketing for us, right? Because we're just, again, we just have been around longer. So we can say we've done that. In the way that we look at deals, I think there's two things on that. One, which is we see where the pressure points are, so we're careful about those because with the big run up there definitely are some pressure points, and I think a lot of people feel like because so many people got into it and some of them were not experienced, there probably may be some opportunities in terms of I don't know that there'll really be distressed deals, but there'll be some deals that'll have to sell. So I think we're on the lookout for that. I mean, so is everybody else, and I like to say right now everybody is either giving or getting preferred equity, and we tend to focus primarily on buying properties, but we did a couple preferred equity deals last year because the opportunities presented themselves. So we're sort of working around, seeing where the opportunities are and just understanding, where that fits in with our strategy. But again, we tend to be relatively conservative and sort of, stick to our basic strategy that we've had for 9+ years.
Yeah. Do you see that it's becoming a, when this all started, when interest rates started slowly going up, people were talking about the change from a seller's market to a buyer's market, right? Yeah. Where it's easier for you, brokers all of a sudden reach out and say, hey, I have a new property. Are you feeling that change? Are you feeling more and more assets being put into the market? Or do you feel like it's just a tug war game between asset owners and people that want to invest in assets?
Yeah, I mean, I think there's definitely fewer assets being sold right now and on the market. I mean, I think the stats are out there, 70% decline and all of that. So there definitely are fewer assets, and our pipeline is not as big as it was 2 years ago when we had 3 pages of deals that we were looking at. But I think a lot of the people out there now, I think if you have experience and you so you say it's a seller's market versus a buyer's market. I think it certainly was a seller's market 2 years ago. 2 years ago we did 8 deals or whatever. We on the contracts, we were like, well, we have no leverage here. We'll just whatever they tell us. And today you can push back a little bit more. So it is, but if you want to buy deals there, for deals that are realistically priced, and that are, solid deals. There's still a number of buyers out there. And so we still act the same way that we did before. Our big thing is we try to say, we do what we say we're going to do, and we do it, and we try to move fast and have no surprises and all that. And we still act like that. So I think maybe it was a seller's market. I don't know that it's 100% a buyer's market right now. I think if somebody if you have a property today and you have to sell it and you're realistic about what the price is, you'll get some buyers for it. And it's not a buyer's market.
Yeah.
But certainly the balance of power has changed. And I think that the brokers, who obviously are the gatekeepers on a lot of these deals, are a little more, a
little nicer when you give them a call, right?
Yeah. They have a little calls back. Right. All of a sudden we have since we're in 9 markets, we're based in the DC area. So, we do deals in Texas. All of a sudden we start to have, we were just talking about, some guys are coming in tomorrow. We have, all of a sudden, a lot of brokers are calling and say, "Hey, we're going to be in town. Can we come by?" I was like, "We're coming by 2 years ago." Now they're all coming by. So I guess that's good for us.
That's amazing. That's actually pretty good. So we have to keep what I call the 20-minute rule, which is so the episodes are more digestible. But at the end of every episode, we have what I call a shameless plug, which means that you can shamelessly talk about yourself, Railfield, new opportunities that you have, anything that you're looking for right now, as we share this with our audience. And, things happen through our network, so you'll never know.
Yeah, no, I appreciate that. I think the feedback I always get from our marketing people is I'm not shameless enough. I'm not too
Go
much.
ahead.
So
Go ahead.
I have to step out of my comfort zone a little bit. But, I always tell people when I meet with them that, so Railfield is that we're based here in Bethesda, Maryland. We focus on the Mid-Atlantic, Southeast, and Texas primarily. We buy multifamily. We have actually 3 joint venture funds focusing between 60 and 120% of area median income. So that's basically, from affordable to sort of core plus. Mm-hmm. So we sort of invest across the spectrum. And I would say we're always looking for 2 things, which are deals and money. So anybody, if you have a deal you want to sell, please talk to us. We move fast. And we're always looking to meet new capital relationships and talk to people about investing. We have a good track record and a lot of experience. So, we never have enough of deals or money. So, that we always have time to talk to somebody about. That's pretty much what we're looking for.
That's great. Yeah. Jon Siegel, thank you so much for joining me on another episode of the Dealmakers Coffee Break. I really appreciate you coming.
Yeah, thanks for having me. Appreciate it.
Thank you for joining us. Check out more episodes on the Dealmakers podcast, available on Spotify, Apple Music, Google Podcasts, and Agora's website at agorareal.com/podcast. See you in the next episode.